so much for joining us. I'm Sam. I moderate these presentations, and in just a second, we're going to be joined by Wesley Boudreau, one of our very experienced financial advisors here. He's going to be giving you some updates on changes coming to taxes for upcoming 2026 tax season. I cannot believe it's already almost 2026, but nevertheless, he'll be giving you all the updates you need so that you can prepare. Before he comes on, very quickly, want to remind you that we are not endorsed by any specific company. We are not with your company. We are a group of financial advisors, so please keep that in mind as you're listening along. On the screen, you will find a Q&A box. It's completely anonymous. Feel free to ask away while Wesley's speaking. We would be thrilled to answer your questions with you after the webinar has ended. I'll reach out to one of our advisors and make sure that they reach out to you, either through phone or email, to answer those questions with you. You can also click the links that are going to pop up above Wesley's head. They're going to guide you to our website. Click on those. You can book a free 15 or 30-minute block of time with one of our advisors. You can also subscribe to our newsletter and take advantage of all of the blogs that we have available. We have many, many blogs to keep you updated on your retirement. So take advantage of those. And without further ado, let's jump right into it with Wesley Boudreau.
All right, thank you very much for the introduction there, Samantha. And like she said, my name is Wesley Boudreau, one of the financial advisors here with the Retirement Group, now part of Wealth Enhancement Group. We'll get into what that means a little bit later at the end of this presentation. But today we're going to kind of dig into some different tax situations. Again, obviously, there's so many different items we could cover, so we're not going to cover absolutely everything here. I'm just going to hit on some different highlights as far as what taxes look like for 2025. We've added in some different information with the OBBBA, the One Big Beautiful Bill Act, and what that's changing for 2025 and 2026 and beyond. And we'll just touch on some other things that's necessary to be aware of as you transition into retirement, and some different things to keep in mind as far as planning your taxes going forward as well. So as far as the first and foremost, biggest thing that's always been in the news the last year or so was whether we're going to get this big beautiful bill put into place. The deadline was July 4th. That's when they actually did get it taken care of. And so I've highlighted here just some different key points of it. There's obviously a lot more details and information we can go into. We do have another presentation just on that. But if you have any questions, just give us a call. We'll be happy to dig into them for your specific situation. But one of the biggest benefits was the permanent extension of the original tax cuts we had back in 2017. So that, again, brought down the tax brackets down to the 10, 12, 22, 24, 30, 32, 35, and 37% tax brackets, which were a couple percentage points lower than what they were before. It also kept the higher standard deductions, so a lot of people used to itemize, and that's a lot less of a situation going forward, with the exception of some changes here with the One Big Beautiful Bill that could cause some of us to start itemizing again. So those are the major changes, kind of permanently putting that into effect, at least for now. Obviously, administrations can change in the future, and that permanency can change. But one of the biggest benefits also was the bumping temporarily of the SALT taxes. So that's the state and local tax exemptions that you have. That was one of the biggest knocks of the original Trump tax changes, was that they eliminated that or sent that down to $10,000 as a cap. So obviously for a lot of people that live like in New York and California, even people who live in Texas that have high property taxes but no state income tax, that becomes a big limit because it's not that difficult to get up to that $10,000 mark between state income tax, property taxes, local taxes, sales tax, things like that. So now that's been moved up to $40,000. So that's going to allow a lot of people that were previously using the standard deduction, they might at least run side by side and see, hey, does it make sense to itemize now? Does that actually open up the window for other options to look at as well? And we can go through some of these with you as well. It may introduce bunching as far as deductions are said. Another thing is a lot of different new deductions. I'm not going to go into all of those, but there's some different electric vehicle changes and things of that nature. Increased child tax credits. A lot of other different items in there that we can get over to you if you want to see those one-on-one. And then increase in the federal estate and gift tax exemptions. This is actually a pretty big one. Not to necessarily everybody, because obviously the estate tax is mostly hits the high net worth or ultra high net worth individuals. But it did stand to potentially come back down to where it was prior to 2016 in much lower limits, in which case it could capture a lot of the general affluent population out there that that could get hit with that. and that could be an additional up to 40% on top of what your regular taxes would be on that transition. We'll talk a little bit more about what those limits are a little bit later here. So as far as the 2025, the original standard deduction was bumped up again from where it was last year. It was this is one of the simplest years: $30,000 for a married couple, $15,000 for individuals, and $22,500 for filing head of household filing. The Big Beautiful Bill did actually bump that up a little bit, so we've got those updated, getting a married couple about $1,500 more in deductions this year. Individuals $750 more, and then what's that, about another $1,000 or so roughly for head of household. So again, what you thought before, these are new numbers. They are for 2025, so this is one retroactive or in the middle of the year change that did take place with the Big Beautiful Bill. So again, an extra $1,500 of deductions for a married couple, extra $750 of deductions for somebody who's singled. So we need to factor that in moving forward as well. As far as another deduction was a senior bonus. Now this kind of really, it's a workaround, if you would, for what they talked about making Social Security tax-free. That couldn't really get put into play. I'm not going to get into all the details of that, but what they did was for individuals that were 65 and older, they did a bonus deduction. Now, if you're 65 or older, you've already got some different higher deductions in there, but this is on top of that. So essentially what's giving you is the potential for an additional $6,000 of deductions per person, so $12,000 for a married couple over 65 in this case. And it does not age out, but it does phase out based upon your income. So if you're making over $150,000 a year, it's going to start to go down 6% per dollar that you make above that. So it could be eliminated if you're a high net worth earner, or if you're a high earner, or you got a lot of other income you're generating off of RMDs and things of that nature. But if not, and you're under that 150, it could be substantial. That's an additional $12,000, which gets you up to about 46 grand total or so in potential standard deductions. If we take a look at this chart here, this is top is going to be assuming somebody, a married couple, under the 150 mark, and the below somebody over the 150 mark. So you can see on the top here that standard deduction has been bumped up to the 31,500. There was already 3,200 in additional age credits or deductions in there before the bonus deduction. That bonus deduction, again, that's going to be here for the next 3 years, is up at 12,000 with these couples, or this couple that's under 150. And what's going to happen, that's $46,700 of standard deductions right now. So if they went out there and they made $46,000, there's no taxable income whatsoever. If they made let's say $70,000 and it was just Social Security, there's still not going to be any taxable income, because that standard deduction is going to bring them down so low that their Social Security is going to be tax-free. And that gets into different tax planning, especially if you're living modestly, in which case sometimes you may review doing a Roth conversion, and it may make sense in that 12% bracket, but you may be so low that it bumps you into Social Security taxation. So you need to review all those. But Social Security, the tax on there, it's not, the tax is going to be the same income rate that you're at, but the amount of it's going to be taxed, either 0% of it, 50% of it, or 85% will be taxed. So we can get into that and show you that in a one-on-one basis. But again, this 46 grand is a big chunk, and taking that off. Now, if this couple was making more, they were making, in this case, I'm going to zoom in here without the glasses. If they were making 180 in this case, so again, same standard deduction, same normal standard deduction for 65 and plus, but instead of 12,000, they're getting excuse me, they're getting $8,400 in this case, so 43,100. And this is again because of that 6% reduction per dollar over that 150. So in this case, that 30 grand at 6%, that's going to bring them down to that $8,400 instead of the 12,000. Again, still a sizable deduction, $43,000 coming off the top line when they're filing their taxes here. As far as that SALT, that state and local tax that I mentioned before, again, the changes there for 2025 through 2029 are going to be bumping that from $10,000 cap to a $40,000 cap if you're under $500,000. If you're over that, then there's a phase-out limit on there, and it could eventually kind of bring you back down to $10,000. And they are going to step that up in future years based upon an inflationary bump up there as well. But where this is big is I'll give two examples. Let's assume somebody who's living in California, making $150,000 a year. Maybe their taxes come out to, I'm going to make it up, maybe $8,000 or so for the year. So they're only $2,000 shy of that $10,000 limit, and chances are they probably spend enough money to have sales tax and things like that. There may be other local property taxes and things that in reality this person might have maybe $18,000 of potential deductions, but again, because they took the standard deduction and because the SALT cap previously was 10,000, all they could do is the 10,000 in there, and it told them, hey, I can't itemize. Now they might go in there and look at the fact that that 18,000 might bump them over the threshold, and they could itemize. Or it could be somebody that's making even more money and has a higher income, so it bumps them up even higher. It could even be somebody in Texas that doesn't have state income taxes, but maybe they got a $1 million house, which isn't hard to come by anymore with the way these properties have skyrocketed in the last couple of years. But you might have $1 million house, and you might have, let's say, a 2% property tax. So that's assuming you're not factoring in homestead exemptions, things like that. Now we're looking at that's 20 grand right there. On top of that, you're probably spending money. You got some other local taxes and things. So that person may be able to actually itemize now. So this is really a unique, beneficial thing. It adds a headache because now you might be able to itemize, but it does create more potential tax savings going forward for a lot of people there as well. So keep that in mind. The federal estate tax we talked about before. Again, these numbers are pretty high. Most of us aren't falling into this threshold, but again, some people may. The 2025, the cap is $13.99, so let's say $14 million. So what that means, if you've got an estate individually over $14 million, then you're going to be paying estate taxes on that difference. The key risk here was that if we didn't do anything, this could have reverted back down to lower numbers. So let's assume maybe somebody's got $8 million and they're single, and let's assume that the estate tax had dropped back down and maybe it was $5 million. That means there's $3 million that could potentially be charged up to 40%. So what's that? Another $1.2 million that's gone to your beneficiaries, and that's on top of if this was an IRA and you're paying taxes on it and things of that nature. In a brokerage account, you get step-up cost basis as it stands now. That can always change, but again, if you've got a really substantial net worth, and in this case, it's really beneficial. So again, they're going to bump that up to 15 million even numbers next year. So 15 and 30 for a couple. We say 30 because it's 15 each individual. So you can also you can pass on to your spouse with no limits. You can have $100 million. It goes on to he or she, but again, at that point, then they are limited by that 15 million. So we say 30 million, but you need to do some estate planning in order to get that, because you're going to have to do a bypass trust and things like that to realize all that. So again, give us a call. We'll be happy to kind of go into those details with you. But this was a great benefit because it did bump up that. So less and less people are getting caught up in the estate tax situation. Another issue is if you've got a lot of real estate, it can create a fire sale. If most of your assets are built up in real estate, you get hit with an estate tax, you may be forced to sell, or your beneficiaries may be forced to sell some property to free up money to cover that. So getting into the tax brackets, again, these tax brackets did not change. We're still at the 10, 12, 22, 24, 32, 35, and 37% tax bracket. Still 0, 15, and 20% for the long-term capital gains. What's changed here is going to be the amount that you're taxed on. The breakpoints, if you would, have kind of gone up a little bit, and they'll continue to go up next year and future years. But again, this combined with the higher standard deduction is going to be a big issue. So again, if we take a look at, we like to talk about that 12% bracket because that next jump is the biggest jump from 12 to 22. And that 12% honestly can capture a lot of us because it's gone so high now. We're looking at 96 grand and change for the top of that 12% bracket. And we just talked about, for this is I'm using this for a married couple. I apologize. So for a married couple, 96,000 and change. We factored in, again, there's a 31,500 standard deduction. If you're over 65, it could be up that 46 grand. So you could be looking at, as long as you're under about 128,000 or maybe even under 140 something thousand, if you're over 65, you're in that 12% tax bracket, which I think I'd argue with anybody, those are the lowest brackets we've seen in history and probably will going forward. So again, it's really important to look at potentially Roth conversions during this time period. It's also important to kind of juggle that with different tax brackets, different IRMA brackets if you're going to be over 65 within 2 years. That can factor into your Medicare tax premiums. So a lot of things that kind of go in and out with that. On the, I'll zoom in here a little bit on the long-term capital gains. You can see that kind of goes semi hand in hand with the 12% tax bracket, but under 96,000 and change, you're looking at 0%. Above that 96,000 for, again, on a married couple in this example, 15%. Then once you get over 600,000, you're getting into that 20% range on there as well. So this also goes hand in hand with a lot of our oil and gas clients that I work with, where we're factoring in NUA and balancing that as well, because NUA is going to give you tax favorable treatment on on your specific company stock that's got low cost basis, where you're paying long-term capital gains versus ordinary income. So you could be potentially in 0% or 15%, but typically it's always going to be lower than your ordinary income tax bracket. So again, if you have any questions on that, just give me a call. I'll be happy to run a detailed NUA analysis for you there. As far as contributions and getting into your 401ks, if you're still saving that way, and your IRAs, the contributions for the 401ks haven't changed for 2025. It's $23,500, and then if for the an IRA limit, it's going to be $7,500. If you're over 50, you got the catch-up contribution option, so it's an extra $1,000 for IRAs and $7,500 for 401ks. So you're looking at $31,000 as the max there. There's also other maxes as far as the after-tax contributions and total contributions between you and the company as well. One other unique change is based upon your potential income going forward next year. Those after-tax, the catch-up contributions may be forced to be going into after-tax. So again, if you're a higher net worth or you earn more, give us a call. We can kind of go through the ins and outs of that. But it is based upon the company plan adopting it. So not everybody has yet. It's pretty new in this phase. But if you have any questions, just let me know. And again, the RMDs, the required minimum distributions. The benefit of the Secure Act and then Secure Act 2.0 was they started pushing these back farther and farther. In reality, the required minimum distribution is really just a way for the IRS to say, hey, stop deferring all these taxes. We want you to start taking it out so we can start getting some income off of this and tax you. And it used to be 70.5, then it got moved out to 73, and then 75, depending upon when you were born. So to keep it very simple, if you were born 1959 and earlier, you're going to be looking at 73. If you're born in 1960 or later, you're looking at 75 for your RMD. So again, that's when the IRS says, hey, you need to start taking some withdrawals from your 401k, your IRA, 403b, all your tax-deferred accounts, so we can start taxing you on it. And there's a tax table on there's a table on there, but generally speaking, it starts out a little bit below 4% and starts to go up from there each year. And then qualified charitable contributions, distributions, QCDs. That's another thing to be aware of as far as if you don't want to have your RMD and you can afford not to have it, and you want to go ahead and pass that on to a charity and not get taxed on it, you can do that. The limit's gone up to 108, so $108,000 a person this year. That's if you're over 70.5. Doesn't necessarily mean at your RMD age. You can do it before. So 108,000 this year. In 2026, it goes up to 115. And again, that's per person, so a married couple could do double that. And then you just want to make sure that you understand with these contributions, if you can afford to do it, go ahead and slowly increase those year over year, so that way you kind of increase the contributions that you're putting into that 401k or IRA. But it also may be beneficial to review whether or not you want to do that. You may want to just specifically max out what you can get for the company match if you have that, and it may be that you want to look at moving more to an after tax, so you can do a backdoor Roth strategy, or it may be that you want to save more for an upcoming purchase, a new house or something like that. So again, there's a lot of different nuances, but again, review this each year as you transition and kind of have a clean slate going into January. As far as the 2025 estate and gift tax, we kind of talked about this already, but one of the things we didn't talk about was the $19,000 gift limit. That's a gift limit for both 2025 and 2026, and what that means is that's kind of the, for lack of a better term, the under the radar gift, or the gift that you don't have to report against your gift or estate tax. And so what I mean by that is, let's assume there's no gift limit. Let's say that $19,000 doesn't exist. And what would happen is, in this example, let's assume we got a $14 million estate, and if somebody gave $1 million to somebody, that's going to count against their estate. So whenever they pass away, instead of that $14 million, now they're down to $13 million as far as their estate / gift tax. So again, it's important to know this, but that person could give $19,000 to multiple people and add up to $1 million, and that wouldn't count against that credit. So let's say in this case you're a married couple, and you want to go ahead and give to your kids, or maybe give to grandkids. You can actually, each of you can give $19,000 each. That's $38,000 that you could give to each kid. Let's say you're older and you got grandkids, you want to help save for college. You can actually front load a 529 plan for up to 5 years. That's $160 something thousand or so you could actually put in 1 year. Now again, that means you can't do it again for the next 4 years. But again, there are some different limits there. But it's good to know that above and beyond that, that's where you're going to have to keep track of it, and it's going to credit against your estate tax going forward. As far as the kind of just preparing for taxes, last couple slides just kind of get some reiterating that you need to be cognizant of this. But look for tax planning tips. If you have questions, want us to review your last year's 1040, I can do that. We can throw it through some software to pinpoint some different issues we may want to review, but it also, we do that every year with our clients, especially this time towards the end of the year when we're running Roth conversions and looking at all the different ins and outs of that. Go ahead and prepare for tax season. Don't wait till the last minute. I talked to the CPA yesterday, and it's very simple. How can somebody answer 100 calls on April 12th or April 13th? You need to try and get some of this stuff prepared beforehand. I'm always on top of my father-in-law about this. He's last minute kind of person as well. But try and be nice to that CPA if you're using one, especially if you're doing it yourself. Be nice to yourself. Don't wait too long. Go ahead and prepare. There's a lot of end of the year items to review. I went ahead and threw an extra slide at the end of this. We'll kind of touch on some of those, but just make sure you get all your ducks in a row on that. As far as tax planning tips, you'll leverage those increased deductions we talked about and the different exclusions. So go ahead and take a quick review of the tax brackets and changes for this year, the deductions changes. You can look at bunching options and things of that nature. You review investments and savings strategies. So again, whether you're looking at qualified dividends, whether you're looking at tax exempt interest and things like that on your after-tax accounts, there's a lot of different items to be aware of. Also, work with a lot of individuals that retire, from the oil and gas companies that may be highly compensated and get hit pretty hard that last year with non-qualified distributions and things like that. There are some different tax strategies I can go into one-on-one that can help you reduce or eliminate some of that. You also want to consider consulting with a tax advisor. I would say myself and a lot of the other advisors here at the Retirement Group, we've been around long enough, we've done a lot of this. We can kind of consult with you. We can't at the end of the day hang that CPA nameplate on there and do it for you, but we can give you guidance so we can at least kind of streamline it, make that conversation with your CPA easier. And with our merger with Wealth Enhancement Group, we actually do have CPAs on staff, so if you want us to do your taxes, that may be an option, but again, I would review the pros and cons of that with you one-on-one. As far as kind of preparing for tax season, again, this is a little bit redundant, but organize all your tax documents early. I mentioned that before, especially receipts and stuff now with that SALT tax. I don't know the ins and outs of it, but I don't know if you're going to need every single receipt to show your sales tax, or if you want to go and look at your credit card spending and stuff and back it out that way. You want to be aware of deductions and credits we just talked about, and again, consider professional tax prep. I know Free Tax USA and TurboTax and all those are pretty simple. And if you got a simple situation, no secondary properties, no other businesses and things like that, that might be easy. But if you do want to lean on a professional to see if there's anything else that he or she can squeak out for you, it may be worth it. That may cover their fees in the long run. So again, if you have any questions, just give us a call. And then some of the end of the year things, I apologize, let's see if we can get this focus. There we go. Some of the end of the year items here, the Roth conversions, that's one I talked about we're doing right now with a lot of our clients. You can do that up to the end of the year if you want to get that conversion done. So it's one of those things where we take a look at your 1040, take a look at what your potential Social Security is or other income for the year, kind of see what tax bracket you're falling into without a conversion versus can we max you up to the 12%? What if we do the 22, 24%? How does that pan out, not just now, but the next 10, 15, 20 years? How much are we going to potentially save you in taxes or your beneficiaries in taxes? So we can go through all of that with you, but again, don't wait till the last minute. 401k elections for 2026, make sure you kind of analyze that and see what your options are and see if you want to increase or decrease those. If you want to change them from pre-tax to after-tax, maybe you want to take advantage of a backdoor Roth strategy. If your company allows, you can actually build up after-tax and roll that over either internally or externally into a Roth, so it grows tax-free going forward. If you got NUA, again, this is for a lot of times oil and gas and other companies that have highly appreciated company stock. That's net unrealized appreciation, in which case we can actually get that rolled over to a brokerage account. So you pay ordinary income tax on the cost basis, which is lower, and on the gains you're going to pay long-term capital gains, which is lower tax treatment than ordinary income taxes. But it may or may not make sense for everybody, so it's important to give me a call, and I'll be happy to run through that with you one-on-one, see if it does make sense for you, because there are some different hoops to jump through in some cases. But that's something that you want to do by the end of the year, I say, because if you have separated service and you've passed the triggering events, if you take any withdrawal, you have until the end of the year to get that exercise. So let's say if you retired this year and you took a withdrawal, even a small $1,000 withdrawal, and you don't do NUA by the end of this year, it's done. You don't have an option to do it anymore. So go ahead and give us a call on that. We'll be happy to dig into it for you. Charitable giving, again, a lot of different charitable giving options. There's some adjustments to that this year as well. But whether you're going to be donating outright or doing a donor advised fund or setting up a charitable remainder trust or things like that, You want to get all that done by the end of the year because again, it's going against your tax filing, your taxes for the year, not your tax filing deadline. What people get confused is the up till the tax filing deadline, you can make contributions to like a Roth IRA or traditional IRA or self-employed IRAs and things like that. But for your taxes for charitable contributions, that needs to be done before the end of the year. And then for RMD planning, again, whether you're looking at coming up on your first year of RMD, if you want to defer that and double up the next year, if you want to use UA to cover RMDs, if you want to do a QCD, all those things, again, are tax purposes based upon the end of the year. So any questions, just give me a call. We can go through these with you. But kind of culminating all that, like I mentioned, I've said to give us a call multiple times. This really kind of the best way to view it all is in a plan. Right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 10 to 15 minutes with us, we'll gather some data from you, like 401k balances, IRAs, bank accounts, Social Security income, spending habits, things like that. We can put together a detailed financial plan with a cash flow analysis to show you what it looks like now, but also in 10, 15, 20, 30 years down the road. If you're saying, Wesley, how should I retire now or should I work longer? We can go through those different options. Should I take a pension lump sum or an annuity? We go through those side by side as well, so we can give you multiple variations to show you what your potential options are going to be. And that can help you with that financial side. Then you still have the emotional side as to whether or not you're ready to retire. But at a minimum, we want to at least give you an idea of where you stand. And if you've done one with us before, but it's been a couple years, go ahead and give me a call back. We can update them because obviously things have changed in both the market and interest rates for that. So I know you have worked. I know a lot of you have worked with us in the past, and a quick reiteration of who the Retirement Group is. We are an independent financial advisory firm, been working for 30 years with Fortune 500 companies, helping them transition into retirement. Myself and our other advisors tend to focus on a selected number of companies, so we know your plans inside and out, so that way if you've got questions, whether it be on the 401k, the pension plan, healthcare, retiree, medical benefits, life insurance continuation, things like that, we can go through all those ins and outs with you, and it allows us to kind of help you transition and plan for retirement so you maximize your benefits the company's going to give you. And we just ask that after that or even during that process, if you need help on the investment side, you throw our hat in the ring when it comes time for that. If you're not going to be a DIY, even if you are DIY, we can give you some guidance and kind of help you determine if you want to stick that way or if you want to split the accounts up. If you're working with somebody else, we can give you a second opinion on there as well. Another benefit here is that complementary cash flow analysis I mentioned. We continue to do that as a complementary option in hopes that obviously you throw our hat in the ring or tell somebody else about us when it comes time for the transitioning. And then to kind of add to this, as I mentioned, Wealth Enhancement Group, we merged or got acquired by them last year in 2024. They're one of the bigger RIAs out there, so a registered investment advisory firm. Right now, as of 2025, we got about over $110 billion under management, over 150 plus offices across the United States, 600 or 700 advisors across the United States. So rest assured, if you need to sit down with somebody face-to-face, we can likely accommodate that. You can give us a call. We can work via phone call, email, web communication, whatever your preference is going to be. But again, that benefit of Wealth Enhancement Group is we also now have access directly inside to trust services and estate planning services, tax services, things like that. There's a wealth of other information that we have access to that we didn't have before, and a lot of other firms don't have access to. So again, we can be your one-stop shop to cover any questions or any items you need. So I'm going to go ahead and, speaking of questions, I'm going to try and take care of some of these questions I saw them through. I'll take care of two of them. If there's any more, we can circle back on them. But while I do that, I'm going to leave this up here for a little bit. If you have questions, give us a call at 800-900-5867. Ask for Wesley or any other advisors. And I apologize, this thing keeps going in and out. You can also email us at info@theretirementgroup.com. There's a couple QR codes up here if you want to use that on your phone to get into our LinkedIn to maybe follow along your specific company plans, or go ahead and get into my calendar or others' calendars in order to schedule an appointment with one of us. So some of these questions, let's see here. Can I still make a Roth conversion after my RMD starts? Okay, good question. I think I talked a little bit about the RMDs and stuff, and we talked about Roth conversions, but not the two together. So a Roth conversion, again, that's if you're taking IRA money or 401k money and paying taxes on it and converting it over to a Roth IRA so that now it starts to grow tax-free. So let's pretend somebody takes $50,000. That's going to add $50 to their income for the year. So that's why we budget and look at the 12% versus 22 and 24 and things like that, because that $50,000, this example, may bump them into the next tax bracket. So that break even may take a little bit longer. But what's going to happen is that $50,000, this example, now is going to grow tax-free for the rest of their lives. So they're not generating additional interest that's going to be taxable eventually to them and or their beneficiaries. Now, however, if you are RMD age, if you're already taking RMDs, or if you're about to be 73 or you're going to be 75, you have to satisfy your RMD first. You can still do a Roth conversion, you just can't convert your RMD. So let's say your RMD is going to be $50,000, you have to take that $50,000 first before anything else happens, and then you can do a Roth conversion. Now, if you're lucky enough and you don't need that much money and you're focused more on converting for beneficiaries, you could actually do that QCD we talked about for that Roth, and that way it's kind of a wash. You donate that to charity directly, and that $50,000 doesn't count. Then you can do a Roth conversion, so keep yourself in a lower tax bracket there. So a lot of different planning to kind of go in and out with that, so just give us a call. Excuse me, we can go over that with you. One more I'll knock out. I heard something about bunching deductions. What is that? I think I used the term once or twice in there, but I didn't elaborate on it. So bunching is, especially now that they've got the higher SALT, could be beneficial, but that's when you bunch your deductions. So for instance, in some cases, I don't know every state, but some states you might be able to prepay your property taxes, or pay them twice in 1 year. So that way you bunch your property tax years. Let's say you got $10,000 of property taxes, you can bunch them in 1 year. Now you're paying 20 grand, and that's going to get you above that $10,000 SALT limit, and to get you into the benefit of that new 40,000. It may be that you bunch different deductions in there as well. You may bunch your contributions. So maybe you, on an ongoing basis, you tend to maybe donate $5,000 a year, give or take, to charity. Well, instead of doing that on an annual basis, maybe you can take 2 years worth, or maybe in 3 years worth, and take 10 or 15 grand and put that into what's called a donor advised fund, and bunch those contributions into 1 year. So now you've got higher charitable contribution. So that's what bunching means. It may be that instead of just spacing out and maybe not hitting the itemization options every year, maybe 1 year you decide to kind of bunch some of those different deductions to get to that ability to itemize, and then next year you go back to standard deduction. The next year you might be standard deduction again, or you may bunch again. So that's kind of what that terminology is talking about. And again, if you want us to review your taxes in conjunction with your investment strategy, we can kind of go through all that with you as well. So with that, and one, I apologize about the camera. It hasn't done it before. Hopefully I didn't get too fuzzy for most of it, or maybe it was beneficial that I was fuzzy. But if you have any questions, again, feel free to call us. You can ask for Wesley or one of the other advisors at 800-900-5867. A quick disclosure again, even though myself and some of their advisors have worked extensively with a lot of the companies that our clients work with, does not mean we're employed or endorsed by them. But again, we've got deep knowledge of the company plans, so if you have any questions, don't hesitate to reach out and give us a call. Thank you very much, and we hope you have a great day.